Hey, what's up, guys? I'm Raul Hernandez here. I'm with Danino Capital. I'd like to introduce these guys. They have an awesome program. It's a rent-to-own program, and Dominic's right now, he's gonna break down all it is, all the little nitty-gritty on the numbers. Giovanna and Gino,
That's correct.
are part of his team. And introduce yourselves, guys, and let us know what you do on the team and how all this ties in.
Yeah, welcome everybody. Thanks for being here. I am Dominic Danino, aka Mr. Rent-to-Own Homes. This is Giovanna Danino, our in-house agent and also my business partner and sister. And I have Gino Danino, who's also a real estate agent, in-house, and also my brother, right? So we're a family business. Yep. We like to help people, right? And we are a little bit creative. We're doing something a little bit that's different and outside the box, but it's creating more opportunities for people to get into a home today. The market has shifted, things are a little bit different, and so we're looking to share these opportunities and this method with Raul and other agents so that way they can serve and help more people. And clearly, they're gonna benefit too because they're helping more clients, right? But this opens the door for a lot more people. The reality is 70 to 80% of the people that want to own a home can't qualify for traditional financing. So this breaks the mold in that and opens the door for more people.
Absolutely. I get asked all the time, Giovanna, what is actually rent to own? Rent to own is simply another form of home ownership other than the traditional way for those folks who do not fit the traditional lending box. So yes, we're very excited to talk to you and share our rent to own program to see who is a good fit. It just takes a conversation. So Raul is our go-to person. Anyone interested in finding out about our program, feel free to reach out to Raul. He has a tremendous team behind him. So I am actually becoming his right hand. So if you have any questions in English or Spanish, porque hablamos español, make sure to reach out to Raul.
That's right, Joanna. Again, this is the rent-to-own home program for people that are thinking outside the box. Start thinking outside the box. We have to shift with times. You get stuck in the box. Traditional lending, yeah, but you're gonna get turned down. This is option B. We're gonna try to get you into the original, conventional, method of getting approved by the bank. We're Plan B. We're here to help. Give us a call.
So get your coffee ready, get your tea ready, whatever you gotta do. These next 30 minutes are gonna be awesome. They're gonna break it down, the numbers, they're gonna break down the requirements, and you're gonna love it, guys. You're gonna be recommending this program to everybody you know. And if you're an agent out there and you wanna know more about these guys, hit me up, I'll connect you. All right, guys, so as promised, we're gonna break down a simulation of what it would be to buy a home at $400,000 just to make it easy. All right, and just keep in mind, my disclaimer, his disclaimer is going to be the same. These are not exact numbers. Every situation is different. Every credit is different. Every household is different. Every market is different. So 6 months down the road, give us a call at that time. See what it will actually entail for you. Don't think that this is for evergreen numbers, right?
Absolutely, yeah. So, the market fluctuates, right? And if you're in the market to buying a house, you probably keeping tabs on what's happening with rates. Rates fluctuate. The Federal Reserve does their thing. And so in 6 months, could we be at 5? Who knows? And 6 months, we be at 10? Who knows? When I was originating back in the late 90s, early 2000s, we were at 9.5, 9.75 rates, right? So anything could happen. Right, from that standpoint, the advantage though of getting in now, I keep on saying is if rates do drop, what'll happen is everyone that's waiting for that is gonna wanna jump in. And so that makes it more competitive. And if you don't have deep pockets, probably gonna be outbid, right? So we went through that period of time when rates were super low. We have multiple offers. We had a lot of cash buyers, and if you would lose out if you were getting financing. If somebody else came in with a cash offer, the seller or the listing agent probably take the cash offer if it was about the same amount, right? So that's the thing to watch. So I would say is if you can afford the payment, get in, and then if rates drop, I think the beauty of mortgages in the U.S. when we have 30-year and so forth is that once you get in, you lock in, right? The bank doesn't come and say, hey, we're going to increase your rate unless, you got an adjustable, but typically most people aren't doing adjustables. We typically don't recommend it. But once you're locked in and you could afford that, great. Your payment can only go down. Market changes, your payment can only go down. It's not going to go up. Maybe property taxes could go up. Yeah, that's a factor. factor to keep in mind. And insurance could go up. We know in certain markets, insurance has fluctuated and it's going up. But those are peripheral things as it relates to like a locked-in payment on the principal and interest on a mortgage. You're pretty much locked in, and it could only get better.
So right now, guys, get in now however you can. If you can't qualify for a regular traditional mortgage, give us a call. We will make it happen for you. On a home that's $400,000, you're basically locking in your price. You're helping yourself out to not have to chase the market in the future. That same home can actually become like $450, $475, even $500. So we're talking about a $400,000 example here. So I'm gonna hand over the...
Yeah, so it's pretty straightforward, right? So obviously, the less you finance, the lower your payment is. Just math. Same way when you buy a car, the less you finance, the car may cost $20,000, but if you put $10,000 down, then what's left over to finance is $10,000. And so obviously your payment is going to be lower because you're just financing less. Same thing here on our rent-to-own program, right? And same thing on traditional financing. So what we do as part of our rent-to-own program is we customize it to your situation. Not everybody's situation is the same. And the key here is, what do you bring to the table? Just like in any traditional lending, if your credit score is 800, you're probably going to get a better rate than somebody that's got 600. Same thing. If you're putting 20, 25, 30% down, payment is going to be lower than if somebody puts the minimum 3.5%, 5%. So in traditional mortgages, if you put less than 20% down on conventional, there's also mortgage insurance. So people don't even account for that, it seems, in their payment, but it's also included in there, right? So people say, yeah, I got my principal and interest at 7%. We're at roughly about 7% right now on conventional. My principal and interest at 7% is this payment. And then you have the taxes, and then you have the variable of insurance as well, right? So we don't control the insurance. We don't control the taxes, right? Because it depends on where your property is located and the insurance company that you use, right? We don't force anybody to pick our insurance company. You pick your insurance company, and that's for you to shop, right? So some insurance companies may be a little bit cheaper. So those are some variables. So give yourself some leeway when you're thinking about payment. Taxes and insurance are going to vary location and who your agent is. Now, as it relates to the payment itself, right? So in this example, we're talking about a $400,000 house. So the minimum for our rent-to-own program is 10% down, and part of my chicken scratch, and then there's a 2.5% acquisition fee. So think of it as your closing costs. You have closing costs when you buy a house because the title company's doing work, an appraiser's doing work, right? There's recording with the county. Somebody's got to make sure that you're getting correct title. That meaning the seller is the rightful owner to be able to sell you the house. So that's why title companies do the insurance. These are factors, right? So think of it that way. Acquisition. So we just call it an acquisition fee, a flat fee, right? Does that make sense so far?
Yeah. So $40,000 when he's saying $10,000.
That is the minimum for our program. And the reason why we do it this way is the biggest predictor of people making their payments is having skin in the game. That is a fact, right? That's statistically fact. I used to work for the big lenders, and we look at the data. Is it better to have an 800 score and no money down, or somebody that has got a lesser score and more money down? People that perform better are the ones that have skin in the game because it's tougher for somebody to walk away from that, right? So you have to be committed to want to own. This program is not rent to rent. This isn't a permanent rental. You're going to own the house. Your goal has to be, hey, I need to get my final financing at the end once I've resolved whatever's keeping me from financing now. So you have to be committed. You have to be willing to own the house. And if you're not, this isn't the program for you. And reality is, not everybody can be a homeowner. And maybe you're at a different stage in your life right now where you need to continue either saving up or continue renting. And then as you move forward or improve your situation, then you can own. So we have 10% down minimum. Obviously, we never encourage people to put the minimum. The more, the better, because you're going to get better terms, and also your payment is just going to be more comfortable. That's just the reality of it, right? So if you're putting 10% down, most of the time on our rent-to-own program, we're doing 18 to 36 months, because this is typically how long it takes for people to fix whatever is keeping them from financing. Now, could somebody have a situation that requires a longer period of time? Sure. Could there be somebody that gets it done a lot faster? Sure, that's possible. But typically, I'm going to say about 85% of our rent-to-own clients are 18 to 36 months.
So I just want to chime in here. Keep in mind, guys, so it sounds like a lot of money, but people with ITIN, for example, or just people that are trying to put in like a private lender, right? A private lender to buy their house, it's gonna be 20 to 25%. So that's like 100. What is it? Like
20% is 80,000. 25% is 100,000.
Okay, so $100,000 compared to 50, way better. Like this is gonna basically start you off, put your foot in the door, and actually become an owner eventually.
Mm-hmm. Now, here's the thing, right? I tell people, listen, there's typically three things you got to bring to the table: it's credit, money, as it relates to down payment, or income, high income, stable income, verifiable income, right? Typically, for traditional financing, you're going to need at least two of the three, and potentially you could qualify for traditional financing. Problem is, you may have one, but may not have the other two. So if that's your situation, then you're probably not going to qualify for traditional financing. But this becomes a solution. And one of the reasons why people don't qualify for traditional financing is a lot, as Raul mentioned, right? A lot of self-employed people, a lot of business owners, a lot of entrepreneurs. We have a new, the gig economy these days, right? People are doing side hustles, getting paid $10.99. Maybe they have a taco stand, or they're delivering food. They're doing Uber. So we have all these things going on, right? Yeah, so I mean, the old traditional way that banks looked at people when they were getting financing was, hey, you work at a factory, you work 9 to 5, you make $20 an hour, you work 40 hours a week, and then that's kind of inside the box. And most of the time, they're going to stay in there. There are a few programs that will kind of look a little bit outside of that, but generally, they want to stay in that. Conventional and FHA want you to be in that box, unless you've been reporting your self-employment income for at least 2 years and can document it. Well, your CPA usually is telling you, hey, let's write off as much as possible so we're paying the least amount of taxes. So somebody that has a business, let's say a construction business or so forth, they're bringing in a revenue of $1 million, but they write off $1 million. Well, that doesn't help you when it comes to lending. When it comes to borrowing money, the banks see you as broke on paper, right? You're broke, basically, because the banks will give you credit for what you net, not what you gross. That makes sense? So those are the type of people that are going to, majority of our clients are going to fit into that box. Self-employed is like, you know what? I went to apply. The bank told me no because my taxes or the way that I'm tracking it, or maybe I'm still working or learning how to document my income, right? So it's on the bank statements. Maybe you're getting paid through PayPal, Zelle, Cash App. You got all these ways that people get paid now, right? So most people are like, okay, well, they went to my personal account. They didn't go to my business account. No, I don't have a separate business account. So a little bit trickier to kind of document what really your source of income is. So most banks are like shy away from that because that's not what they want. So this opens the door for you to get into a house now while you're fixing that. Because most people don't find out that, hey, I don't qualify until the day they go apply, right? But you have the money, you have it saved up, and I'm ready to go. And then the bank says no because they don't like all my bank statements or all the transactions that I got going on. So this opens the door for you to still get into a home today. But we're just going to bridge the timeline until you can get that resolved, right? Typically, like I said, 18 to 36 months. All right, so in this example, typically we're going to sell you the property at roughly about 10% than what we pay for, right? So in this example, the sale price in 2 years is going to be $440, but you gave us $40,000 down, right? So we got $40,000. So what you're going to end up financing once you get your own financing is what you paid for. What you pay for. Pretty straightforward. So now we just take what your payment is going to be is, what we want to look at is, we want to put you in a situation to succeed. So we want to make sure that this payment that we're giving you now is going to be close to what your financing is going to look like, because I can't give you a $1,000 payment on a $400,000 house when you get your financing. Your payment is going to be $3,500. That's not going to be good. Are we setting you up to succeed? No. Are you going to be comfortable? If we go ahead and do that and you start going from $1,000 to $3,500, it's probably going to be a problem because you probably can't afford it if you haven't had a history. So we want to have a history of you making these kind of payments. So when you go to your bank or the lender, say, hey, here's the rental history that they've been paying rent-to-own homes. They're making the payments. We have a history. It's coming out of their checking account. We have the bank statements. We have the tracking history. And now when you get your financing, and if your payment is the same, they're going to say, okay, yeah, they can pay it, right? They've been paying it for at least 12 months history. So that validates that you have the ability to pay. We always check your ability to repay. That is a definite factor. So our program is not, hey, I don't have a job, I don't have money. This is not it. You have to be able Now, can we be flexible on the way that we look at your income, as I mentioned, because people have varying sources of income? Sure, but we got to get it all cleaned up so that way when it's time for you to get your financing, hey, you can submit the proper documents through your CPA, and we can refer you to people that know how to work with small business owners to get that all cleaned up. But beforehand, we're still going to review your information to find out, hey, currently right now, if you're renting, I mean, have you been evicted? Do you pay your rent on time? Well, if you're not paying your rent on time, that's a $1,500. How can we get you into a house that's a $2,500 payment, right? Clearly, there's going to be an issue, right? So we will have that conversation with you before we put you into a home, right? But this opens opportunities for people that are kind of have been closed out from the lender standpoint. Now, as it relates to what your payment is going to look like, yeah, so your payment is probably going to look like, so I'm going to pull out my little calculator here on my phone, right? So roughly what you're financing, you're probably looking at $3,300 to $3,700. That's probably what you're looking at, right? Again, the more you put down, the less you put down. So if you were financing $300,000, your payment is going to look like $300,000. Your payment is probably going to look like somewhere between $2,550 and $28,000. Okay.
This here is to avoid the higher payment in the future. So
absolutely.
Right now, yes, you're gonna be paying $3,300 to $3,700 for a $400,000 house, or $2,550 to $2,850 for a $300,000 house. But at least you're not gonna be paying it 3 years later for a $500,000 house. You saved yourself $100,000. Basically.
Yeah, absolutely. Well, there's two things that we want to incentivize you to complete the process and clean up what's keeping you from getting financing. And typically what will happen is by the time you get traditional financing, either conventional FHA, if you're qualified for conventional, this payment is going to drop. But the majority of the time, you're probably going to end up in the $2,900 to $3,200 if you do what you're supposed to do. So we incentivize and say, hey, you can afford this payment, you're making this payment, you have a history of making a payment, but when you get your own financing, your payment's going to drop. So that incentivizes you to do what you're supposed to do, clean up your credit, get your paperwork with your tax preparer, so get it all cleaned up so that way your payment will drop, right? So I'd say 99% of the time, people's payments drop 2 to 3, as much as $500.
Dom, so let's say 3 years later, this house is now worth $480.
Yeah.
All right. Do they need down payment money?
No, so here's the thing, right? We agreed, when you get in, we're agreeing on this price. So if the house went to $1 million, you're still getting it at this price. So anything above that, it's upside. And for those of you that have been in this market in the last 3 to 4 years, have seen an increase, and we've had a ton of people walk into a lot of equity, right? By the time they get their financing, oh, the appraisal came in at 485, 500, 5.25. It's like, okay, right? It has to be a win-win for both sides, and we feel that this is a win-win for both sides, right? Okay. So it works for us as a business and as a program, and then it should work for you as well.
Can they roll any of that equity in the future into their purchase at that point to make them drop the payment?
Well, so the amount financed is still going to be the amount financed unless they come in and say, you know what, I came into $100,000 more, and then whatever you end up financing is what you end up financing.
Oh, so not from the equity of the property.
Well, no, because, okay, so let's say by the time they get their financing, let's say we agreed on $440, let's say it appraises for $500,000. What's owed is still $400. This doesn't change unless they put more money down and say, hey, lender, I don't need $400, I need $350 or I need $300 because I have the additional amounts of funds. Does that make sense? So it's the amount financed.
It's not a refi, it's
a
new purchase.
Yeah, it's a new purchase, but they're getting the equity with it, right? So you close at $440, but the appraisal came in at $500. Well, okay, now that you're in it, what do you have? You have $100,000 of equity. You don't get it in cash. They don't give it to you in the money. It's in the house. Now you can do whatever you want from that standpoint. Either get a home equity loan, or if you sell it, okay, well, I capture it, right? We don't capture equity until we sell, right? So it's not money back.
Or they can purchase it at what they agreed to purchase it for.
Yep.
And then 6 months down the road,
if they want to sell it, absolutely.
No, maybe just refi that equity, roll it back into their.
Yeah, they could potentially do a cash out refinance down the road, right? Because there's some limitations, so you gotta own it for at least 6 months before you can do a cash out refinance down the road. But again, you're rolling the dice in that, okay, let's say it values at 500,000 and you're financing 400,000. Could you do a cash out refinance? Yes, but then now you're back to the issue of payment, right? You can't have both. You can't have low payments and more money in your pocket, right? It's one or the other. You're giving up one or the other, right?
I'm just saying. Like,
no, absolutely. You have options. It gives you options. But if you didn't get this house now and you're waiting, you're waiting for 18 or 36 months, this house is gone. The price of the house is probably higher. It's not going to be in the school district location that you want, that you like, that your spouse likes, that the kids like, your pets like, right? So that's why you want to get in. You want to get in now and lock it in. That's the beauty of this program. And it's not like we have 3 houses and say, hey, pick one of our 3 ugly houses and that's all we got in inventory, right? You get to pick that house, right? That's the beauty of it. You get to pick it. So later down the road, say, well, no, if it was the other programs, which I know there's some people out there that do those kind of programs, they got the ugly house programs. Like, if they give you one of those ugly houses, I mean, could you theoretically call and say, hey, you gave me this crummy house, I don't want it, it's falling apart. All of our houses are retail ready. They're on the MLS. They have to pass inspection. They have to appraise. So we don't put anybody in ugly houses. And there's an issue in the inspection. We don't even, we counsel you not to move forward, and we won't even buy it anyways, right? So we don't do ugly houses.
All right. Thank you, Don.
You're welcome. I can keep talking about this all day, you know.